Welcome to the deep dive. Today, we're digging into a pretty big question. The U.S. stock market, the S&P 500, you know, where might it be going in the second quarter of 2025?
Yeah, it's a question on a lot of minds. And to help us explore that, we've been looking at this analysis from a YouTube channel, Aya.
Right.
The specific video from late March 2025 talks about whether the US dollar is the key to saving the market. It offers some interesting angles.
Okay, interesting. So our mission here is really to pull out the key insights from that source, understand the potential turning points they see without, getting totally lost in the weeds.
Exactly, just the core ideas.
So where did this analyst originally see things heading? What was the initial outlook?
Well, they'd been floating this idea for a bit. Short-term bearish, maybe, but longer-term bullish for U.S. stocks.
Okay.
And they specifically flagged April 2025 as a potential point for a downturn.
And why April? What was the trigger supposed to be?
It was tied to the formal announcement of Trump's reciprocal tariffs. They use this phrase, see.
The bad news is finally out.
Pretty much. The idea is once that uncertainty is gone, maybe the market moves on. It's that classic buy the rumor, sell the news kind of dynamic.
Right, right. So the expectation was that the market might actually stabilize or even bounce back once the tariffs were officially announced.
Yeah, that was the thinking, that once the news was out, the market could potentially get back to an uptrend, or at least see a decent rebound during Q2.
Have we seen that play out before, that kind of sell the news reaction?
Oh, definitely. It's quite common. Markets hate uncertainty, so sometimes the lead up is worse than the actual event. Think about like Fed announcements sometimes.
True. Okay, so a possible dip, then a rebound. What about valuations? Did they look at PE ratios?
They did, and they focused on the S&P 500 equal weight index, which is interesting.
Okay, equal weight. Remind us quickly, how's that different from the regular S&P 500, and why use that one?
Sure. So the standard S&P 500 is market cap weighted, meaning, Apple, Microsoft, the huge companies have a massive influence. The equal weight gives every company the same importance, big or small. So it gives you a better sense of the sort of average company's valuation, maybe. It takes away the skew from the giants.
Right, a broader picture. And what did they find there?
Well, by late March 2025, the PE for that equal weight index had actually fallen below 16.9 times.
Below 16.9. How does that compare?
Pretty significant drop, because back in the second half of 2024, it was closer to 19 times. So definitely some cooling off there.
Wow, okay. And did they put that 16.9 number in historical context?
Yeah, they did. They compared it to the 10-year average for that same equal weight index going back to 2015.
Yeah.
And that 10-year average was also 16.9 times.
Huh. So at the time of the video, the valuation was basically right at, or slightly below, its decade average.
Exactly, which usually suggests to investors, well, what does it typically suggest?
That maybe things are looking a bit cheaper, potentially undervalued, maybe an attractive time to get in.
That's the general idea. When PE is below average, it can signal that prices haven't kept pace with earnings or that there's value to be had. It often attracts buying interest.
But they did add a caution, right? It's not like a magic buy signal.
Definitely not. They pointed out that historically, there have been times the index kept falling even after the PE dropped below average.
Why is that? If it looks cheap, why wouldn't people just pile in?
Well, valuation is just one piece. You've still got overall economic worries, maybe concerns about future earnings, investor sentiment. Lots of things can keep prices down, even if the current PE looks okay.
Gotcha. So a useful indicator, but not the whole puzzle.
Precisely.
Okay, so we've got the outlook, the valuations. What about those seasonal patterns? How the market tends to behave at certain times of the year.
Right, seasonality. They looked at the average S&P 500 performance, this time the regular index, from 2015 to 2024.
And what's the typical pattern over that decade?
Generally, a potential pullback, maybe February into late March, sometimes linked to post-Lunar New Year selling or just a breather. Okay. Then often an upward trend kicking in, running until maybe September, October. Then another possible dip before a year-end rally in November, December.
But like they stressed, that's just an average, isn't it? It could hide a lot of variation year to year.
Absolutely. It's like averaging the wealth of a billionaire and someone, well, less wealthy. The average doesn't tell the whole story.
Good analogy. So how did early 2025 compare to that average pattern?
There were some similarities, like 2025 did see a high in February and then a drop into March. Though the analysts noted the swings, the the amplitude, might have been bigger this year. More volatile.
Okay.
But the key thing was this rebound happening in late March when the video came out. Based on that historical average, if the pattern held, it could suggest a stronger rally coming in April, May, and June.
Interesting. Did they look at any shorter-term historical data, too?
They did, yeah. They also looked at the average from just 2020 to 2024, a more recent 5-year snapshot.
And did that show something similar?
Pretty much, yeah. That shorter average also pointed to a bottoming out around March 23rd, typically, followed by potential strength in April and May.
And they felt 2025's movements kind of tracked that recent pattern, too.
They perceived some similarities, yes. Again, always with the caveat that history doesn't repeat exactly.
Right, and this volatility ties back to what they said earlier about 2025 being a year of big swings.
Exactly. They even linked it to the year of the snake in the Chinese zodiac, known for being a bit unpredictable, sharp turns.
Okay, fascinating stuff. So valuations, seasonality. What about the U.S. dollar? That often plays a big role, doesn't it?
Huge role. They looked at the U.S. dollar index, which measures the dollar against other major currencies.
And the connection to stocks.
Historically, they pointed out big drops in the dollar index have often happened alongside and maybe even worsened S&P 500 declines. They cited 2002, 2008, 2011 as examples.
And they saw a similar dynamic playing out around the time of the video.
They did.
So what's the logic there? Why would a weak dollar hurt U.S. stocks? I thought sometimes a weak dollar helps exporters.
It can help exporters, that's true, but from a capital flow perspective, a strong dollar often means global money is flowing into the U.S., seeking safety or opportunity in U.S. assets, including stocks.
Ah, okay, so a strong dollar signals demand for U.S. assets.
Right. And conversely, a weakening dollar might suggest investors are pulling money out of the U.S., selling dollar assets, maybe looking elsewhere. That selling pressure can hit stocks too.
So the implication is, if the dollar index could stabilize or strengthen, it might help put a floor under the stock market.
That was exactly the point. And they noted that around late March, the dollar index had shown signs of stabilizing, maybe even ticking up slightly,
Okay.
which they saw as potentially positive, maybe helping the stock market find its footing too. They really highlighted the dollar index as something crucial to watch for any sustained rebound into Q2.
Got it. Dollar strength potentially equals stock support. Now, they also brought up foreign investment, which I found really interesting.
Yeah, the amount of U.S. stock owned by foreign investors, it's grown a lot.
How much?
They said it went from like 2% back in the 1960s up to nearly 18% by 2025.
Wow, that's a huge jump. Easier access now, I guess.
Exactly. Global markets are just much more connected. But here's the counterintuitive bit they raised about the dollar.
Yeah.
They argued that a weaker dollar can actually make U.S. stocks more attractive to foreign buyers.
How so? Seems backward from what we just discussed.
Well, think about it from the perspective of someone holding euros or yen. If the dollar weakens, their currency suddenly buys more dollars.
Ah, so U.S. assets effectively go on sale for them.
Precisely. So a falling dollar, while maybe signaling some capital outflows, could also simultaneously act as an incentive, a discount, for new foreign money to come in.
Okay, that's a neat twist. So it's not necessarily all bad for stocks if the dollar weakens from that angle.
Right. And they also mentioned that while foreign investors do think about currency risk, often the potential gains they see in U.S. stocks outweighed the worry about the dollar losing a bit of value against their home currency.
So the overall picture there is that this continued pool of foreign investment, maybe spurred on by attractive valuations or even a weaker dollar discount, could provide ongoing buying support.
That was the argument, yeah, that foreign buying plus reasonable PEs plus those seasonal tailwinds could all help prop up the market.
Okay, so let's pull it all together. We've got the initial outlook, the PE levels, the seasonal averages, the dollar's role, foreign investment. What was the analyst's bottom line for Q2 2025?
The main expectation was that the market could probably catch a break in the second quarter, find some relief from the Q1 turbulence.
A respite.
Yeah. And specifically that tariff idea, again, maybe once the tariff news was fully digested in April, the positive factors could start to take over. Buy the news, essentially.
The flip side of sell the news.
Exactly. But, they were careful to add that Q2 is 3 months long. April is just the start. Things would need ongoing watching.
Makes sense. So if we boil it down, the key takeaway for you, the listener, from this analysis is a potential pathway for a U.S. stock market rebound in Q2 2025.
Right. Driven by valuations looking more reasonable historically, seasonal patterns often favoring that period, maybe some help from a stabilizing dollar, and that persistent foreign buying interest.
Which leaves us with a final thought, maybe something for you to consider. This analysis focused on valuation, seasonality, the dollar, foreign flows.
But what else might be crucial? Think about actual company earnings reports as they come out. What about the global economy beyond just the US dollar, things happening in Europe, Asia? And then there are always the unforeseen geopolitical events.
Right. How might those factors either confirm this potential Q2 rebound or maybe throw a wrench in the works as the year goes on? Something to keep watching.